Hi everybody, I'm in Cape Town. Summer is coming. The sun is going down later. The wine is coming out of the fridge earlier. So it all sort of melds together for quite a good thing. I was talking a little bit earlier, some of you may have heard that this year has come almost to an end quite quickly. We're in October, halfway through October almost. And before we blink and know it, it's going to be the end of the year and holidays, and some of us in the Northern Hemisphere, or the eastern side of the world, or western side, or wherever we are, we sort of start winding down. And we were saying to an Australian group this morning, presentation, that this could actually possibly might be the last note that we do this year. You know, it closes on the 17th of October, and it actually kicks off about 10 days later on the 27th, excuse me. So that takes us into November. And then pretty much, I think things do start slowing down. So we might squeak another one out, but this certainly is one that we're very excited about. Our last two raises have been overwhelming in terms of the response that the community, the investment communities globally, have shown us. Graham, who's on the call, and the other man representing IDAD, our structure, has been an absolute gem in terms of coming to the party and bending the arms and arm wrestling and biting ears and pulling hair and basically getting us extra capacity, because every contract has a limited capacity and there's only so much that the banks will go to. So thank you, Graham, in advance for pushing out the boat for Cashbox, because we always seem to come back and ask for more. It's a little bit like Oliver Twist. And for those of you who are on the weekly wrap, the weekly sort of roundup that I send out, that was a nod last week. Quietly to Graham, that we have some more, sir. And this is the third one that has really taken us by surprise. So I think what is happening is that we're hitting the right tenor in terms of the the sector and the thematics, and in terms of how it's resonating with issues that are going on that affect all of us. And it's been quite a tumultuous year, like every year is. There's always something new, there's always something challenging. And I think in challenge, there's every opportunity. And it might sound like you've heard this all before, it might sound like a silver tongue with marketing, but there really are opportunities to avail oneself. And I think where we've been going this year is into the defensive opportunities, which counterintuitively have been offering great returns. You know, normally sectors like banks, sectors like energy, and this particular, sector, consumer staples, up on the screen, are generally fairly boring type of sectors that people go and snout around for investment opportunities. The whole year has been fueled by this AI bubble, the momentum of AI, the momentum of tech, the shenanigans that are going on with all the various companies taking stakes in each other, fueling this momentum. It's great, but it's very fizzy, and with fizz comes a lot of volatility. And Cashbox, I always in my comments on my weekly monologue, or my document I put out, is that may you have a sage and profitable week ahead. And I think that's where we've moved to this year, in terms of all these buffeting headwinds or sidewinds, whatever, that can knock us off our trajectory. The notes have been designed to perhaps bring investments more behind the castle walls, to build an economic moat around the investment, to try and get the best terms and obviously the best sectors that resonate and that are going to hold up against these headwinds. And we'll deal with some of those tonight. So it has been successful. And I think I can attribute perhaps a lot of the interest in these notes to this sort of sentiment. And sentiment is a very fragile thing. It's intangible. You can't hold it. But I think people are all feeling a little bit overwhelmed by some of the things that we've had to deal with this year. So let's have a look at what we've got on the deck tonight. It closes on the sorry, Jill, can you just go back there for a second? It closes on the 17th of October. It's underwritten by BBVA. We'll deal through that. It's a consumer staples, reducing Autocall. To Jill's point, there's lots of garbage in there, or verbiage, should I rather say. It's consumer staples. And we'll take you to exactly what consumer staples are. And it has something called the reducing Autocall. We built that into all our notes. It allows, obviously, the bank an early exit, and it allows us to basically press a reset button. And especially for a growth note, you need the contract to what's called Autocall. And if you've got a reducing Autocall, it makes it easier and easier. But look at the sector we're in. Staples, which is generally boring. You know, these are companies that are not making headlines every day, but it's got a US dollar 15.4% per annum contracted target return. That's very impressive. That's almost at the tech level, what we can get in some of the sort of tech companies and tech notes that we produced. So why are the banks prepared to pay that premium? And we'll show you why. So it's semi-annual 7.7, and we'll take you through that. So moving on to the next slide. And this is where I wanted to give a sort of a nod to Logan, who sits behind the scenes all year round, very quietly, does our tech, does all the complicated stuff that I don't understand in terms of putting QR codes together, etc. This is something that I thought is quite, we tried it tonight. We've got a WhatsApp group. So it's not a discussion group. It's not for conversation. It's really like an early warning signal where we say, this is what we think is happening. There's a bit of an alert. Go and inform yourself about maybe something's happening, as Greg was saying, with the gold price, or another French president's coming along. Are there opportunities? Are there threats? Should we be thinking about it? Yes, we're addressing it. So it's really an early warning system, but it's for people to literally, be informed on an early warning basis. So if you aren't on this, join on it. This particular little notification went out last night, simply to the people on the group. Some of who've expressed interest in this product, some of who've actually invested already, some have reserved, to saying, guys, we're down to 40% already of what Graham was managed to arm wrestle out of the investment bank. So it was just a sort of little nod that if you were hovering, attend the webinar, think about it, and if it makes sense, press the button, because we've used up capacity quite quickly again. This is the third one of a series of 3 that seems to have done this way. So thanks, Logs, for everything you do. They're the various links, and I think we'll be using the WhatsApp group as we expand it. I think there's 60 investors already on it, and we're going to expand it to the wider group, even if you're not an investor, just for the community. So don't miss those updates, and let's move on. So why staples? What are staples, and how does it affect the US? So this is a US dollar-based note. It's relative to staple consumer goods, and we are talking about the man in the street in the United States, US consumers. Okay, well, what are the issues they're facing? Well, pretty much what we're all facing around the world in one way or another. But because this note is themed to the US, we've got to look within the US and sort of put on a Stars and Stripes hat and have a look to see what they're dealing with. So in the United States, a lot of this is in the news. It's a quite complicated situation because unlike the UK and unlike the EU, their interest rates haven't come down exponentially over and steadily over time. For 1 year, since they hit the plateau sort of late 2024, we've only had one rate cut, and that was sort of last month. And there hasn't been a lot, so they've been sticky. And then the Federal Reserve, which is an apolitical body, under stress and under pressure from the United States administration to cut rates, is saying, well, if inflation is sticky, then we've got to keep interest rates where they are at this level, 4.25%. So what that means is that over the last year, as these rates have been quite high, people who are buying, doesn't matter what you're buying, doesn't matter what you owe, you kind of think when interest rates are high, well, let me keep some of my powder dry. Let me not put my head above the parapet and be too extravagant. Let me service my debt. Let me service my credit payments, my car, my mortgage, my house, my business finance, my lending, etc., etc. My borrowing, etc., etc. And that obviously impacts down into discretionary spending. Ultimately, at the end of the day, like we all do a budget, somewhere along the line it says how much you spend on food and entertainment and all that. We've all done these exercises. We should have done these exercises. But these exercises point to one thing. At the end of the day, you still have to live, and living is sustained by sometimes basic essentials. And the mantra of this, of the rationale that I put out, was a title of essentials in and luxuries out. Because what we're seeing in America is, because of these high interest rates, and you're probably reading ahead, and please do, discretionary spending does get impacted. And with this increasing inflation, food inflation especially, okay, it's one of the input drivers into the overall, consumption of inflation. And the data reports are saying that it's not coming down as rapidly and as aggressively as the Federal Reserve or the government, especially as Donald Trump would like. And it's creating a situation of lower job creation. Some of the unemployment figures are coming through. People aren't hiring as much. So you've got the situation of government wanting to reduce interest rates, but inflation is sticky, and people are losing opportunities for employment. So it points towards something called wage disinflation, which means wages they're not going down, but they're not rising as fast as what a normal economy would allow them to do. So they're going up, but not as fast as maybe a growing economy should do. And the States has been very resilient, amongst all these sort of convulsions of tariffs and interest rates and the National Guard being called out for various things and a whole host of things. They've actually been quite resilient. Okay, people are still spending. I look very closely at the earnings that come out quarter on quarter by companies that we follow, companies that are listed on the major exchanges, and they're all reporting great earnings. Not just the tech companies, but great earnings. And we're going to show you some of the earnings of these companies that we've targeted for very good reasons. Now, one of the big points I brought up in this last week's the week-on-week sort of synopsis, the weekly wrap, was what happened on the 1st of October when the US government the federal government failed to agree in terms of, should we print more money? Are we going to have more budget? And because it's Republicans versus Democrats, there was a big fight. They couldn't get to an agreement. And the government many departments have closed down, which is very tricky for the guys trying to bring interest rates down because they're very data dependent. And many of those offices that produce that data are now closed. So they're kind of flying blind a little bit in terms of where do they get their data, and they're very data hungry. Where do they get those data points from to feed it into their process to understand, is it the right time? And Jerome Powell, who is the Federal Reserve Governor, made a speech yesterday. Their notes have come out today. I read them very thoroughly. It's very dovish. By that, what I mean is that they are aware that this is going to impact, this shutdown is going to impact on them, but they do believe that they're still on the right trajectory, that they probably are going to have another rate cut on the 28th, 29th when they meet, or this month, and potentially another one in November. So they're on track. They're saying that we're going to try and stay on track. Hopefully this shutdown gets sorted out. And the longer it goes on, the worse it becomes, quite frankly, for businesses, for sentiment, for you name it. It's not a good thing. And as I mentioned, this is not Donald Trump's rodeo in terms of first rodeo in terms of shutdowns. He had the longest shutdown ever in history. In his first administration, I think it was 35 days. It all went around like, let's build that big wall to keep the Mexicans and everybody else out from South America, and that caused a problem. So one of the areas that I've been looking at, so the American consumer is under pressure. Okay, he's been under pressure for quite a long time now. He's had high interest rates. They've only come down once. He's got all these headwinds facing him. 750,000 federal workers could be furloughed by this shutdown. Now, if that goes into if these people get fired, as Donald Trump is now saying, I'll fire you guys, especially if you're a Democrat. Okay. And I'm not making light of this. This is reported, not just on Truth Social, but on CNN, on CNBC, Sky News. You can read about this, that there's going to be a lot more people unemployed, which means they're not going to have money to spend on luxuries. It's going back to essentials. So we looked at this from a perspective of strategic. How do we bring a note into play when people are stressed, they are under pressure, there's constrained spending? In terms of, well, I'm not going to go out and buy the normal things that I buy. I'm now going to try and buy more bulk at a lower price, but the same quality, and maybe it's going to be store branded. Maybe it's going to be trading down. Okay, and this is the theme to a large degree of this note, is that people still need to live. There still needs to be food on the table, essentials in the pharmaceutical cupboard, cleaning equipment, you name it. We'll take you through it. So the trading down theme is a sort of a golden thread we can pull through this entire sort of presentation. Just keep it in the back of your mind. So let's have a look at these companies, if you may, Joel. The top one is not a consumer company. It's an investment bank, BBVA. It's an acronym for the 16th or 15th or 16th largest investment bank in the world. It's a Spanish multinational, global, systemically important bank. We've had a long relationship with them. Our structures have a great working relationship that we can squeeze that little bit of extra out of them when it's needed. And they're a global bank, tier 1, A-rated. We've done a lot of work with them. We've got a great working relationship. And they understand the structured note environment very, very carefully. The counterparty is BBVA. They are writing this debt. In other words, they're giving us the credit, they're giving us the debt note, and they're saying we're prepared to pay you 15.4% if you give us the money. And an A-rated bank and a tier 1 bank is very important in terms of not just that, but we look at other issues as well to make sure that this is the right bank we want to deal with in terms of the contract that ultimately you as the investor have with them. That's very, very important. So let's have a bit of a gander at the companies. Some of them are household names. I mean, let's start at the top, Walmart. Can we just go back to the previous slide? Sure, sorry. Just Walmart. I'll just take you through a general sort of synopsis, because then I want to look at what they actually make in terms of money, given that people are watching every penny and every dollar where it goes, and yet these guys are money-making machines. So where do they make their money? So Walmart is pretty much, I look after a lot of discretionary portfolios, and Walmart, when it's included, I mean, Walmart's listed on the New York Stock Exchange, is also a constituent of the Dow Jones, okay, which is the sort of blue chip 30 largest companies and blue chip companies that are in that index. And we pretty much use it as a proxy. When we include consumer staples, we include Walmart, it's pretty much a proxy for constrained American consumption. Okay. It means that, they've based their model on scale because they are absolutely massive across America. They have something like 2.1 million employees through affiliate relationships or direct Walmart branded stores. That's a massive amount of people. Okay. They have, because of their size, they have pricing power. And they have diversification right across America, okay, in terms of north to south, east to west. It's a household name in the States. So in the context where I mentioned earlier, where American households are making trade-offs or trading down, okay, Walmart gains huge market share because it can undercut competitors, specifically on price. The bigger you are, the more you can undercut and squeeze your margins. And they have, all these companies, all three of these have very small margins, but it's volume that drives these guys. This is a volume-based game. Okay. So they're very competitive on price. They've got a mantra. It's called everyday low prices. You'll see that in their stores. And it almost acts as an inflation buffer. It allows them to catch a volume, especially from middle class, upper class, and lower class. They look at all the different strategies, and there's something for everybody at a certain price. All these companies, especially Walmart, but all of them, have integrated and accelerated their digital footprints in terms of home deliveries, home ordering, e-commerce, online advertising. They've gone into healthcare. Obviously, Walmart and Walgreens are one and the same. It's the biggest pharmaceutical chain. But we've concentrated on food and drink mainly, not so much the pharmaceutical side. So in terms of what Walmart presents, is that their financials present modest. When I looked at their financials, when I drilled into them and did my interrogation, they show modest margins, around 4% profit margin. That's not a lot. But they have massive cash flow in terms of people in their shops every single day. They've got solid credit ratings, and they've got a stable and modest dividend as well, which is a fantastic feature for a portfolio manager, for institutions buying. Running down Dollar General, they probably at the other side. They're an ultra discount retailing sort of operation. They're based on ultra discount retailing. Basically in rural America. So not in your Bostons, New York, San Francisco, Tennessee, Dallas, or places like that. It's more rural, countryside type of dispersion, where consumers often in a rural environment are more sensitive to the purchasing power erosion that they might be feeling. Okay. And they become a very big net beneficiary of this trading down, of buying maybe a store brand, of a cheaper brand, maybe bigger bulk, etc. But it's in a regime where, food inflation is slowing, but where it's remaining above overall inflation. Kroger, beg your pardon, Dollar General is very, very well positioned. Okay. They're also a modest 6% margin. So you've had 4% from the biggest guy on the block, Walmart. You've got 6% from these guys. I think Kroger around about 4%. So it's very, very low margins in terms of what they're trying to make out of your wallet, out of your dollar in terms of per purchase. But it's the volume game. Okay, again. They've had a lot of rollout of new ideas. So Dollar General is probably the biggest value play at the moment. The pricing of Walmart and Kroger are quite high at the moment. Dollar General is spending a lot of money on refurbishing stores, new stores, rolling out a brand new operations, and that costs money. And so in terms of their share price, that's come down a little bit. That gives us a great entry point. If we have to say Kroger and Walmart, we're probably buying in at the higher end. Dollar General is a great buy. If you look at the side sell analysts on Wall Street, they see it as a complete value play at the moment. It's got pretty much a good capitalization. Last month, last year it made, I think, 47 billion, but we'll get into that. So let's deal with Kroger. Okay, who are Kroger? It's also not maybe a household name outside. They're the second biggest, I call them grocers. And I was told, no, they're a food retailer. Okay, they're the second largest food retailer in the United States. And they profit. Most of their profits come from their private labels. So it'll be Kroger mayonnaise, Kroger eggs, Kroger meat, Kroger fish, Kroger milk, you name it. Okay, they brand it in terms of a house brand. So they capture a higher margin because it's their own. And certainly many constrained or consumers under pressure flock towards Kroger. Kroger is a money-making, it's a cash flow machine. We'll show you some of the numbers about the profitability of these companies. With such small margins, boring sector, we all go buy toilet paper and washing powder and toothpaste. These guys print money. Okay, it's very, very interesting. And they're very, very well positioned for, even if interest rates do come down, as I mentioned, they probably are going to come down. Hopefully they do. They're still well positioned. So great companies. They are global as well, but we are focused on the United States here and the sentiment surrounding what these guys are facing in America. Okay, so let's see what comes next. Okay, so if we move on to these underlying, so here's a little bit of financial metrics. Okay, are these guys profitable? Because I've sort of spoken them into a boring corner. But look at Walmart. It has a market capitalization. The size of its business is 823 billion. It made more revenue last year than Amazon. Okay, so if you hadn't heard of Walmart, it made more money than Amazon. You might have heard of that little company. If you look at its revenues, over 500 million, 600 odd billion of revenue. Now, revenue is one thing because it doesn't take into consideration, that's gross revenue, doesn't take into consideration costs and inputs and all the rest. And I did there for all the companies. I did basically from 2021 right through to 2024 in terms of what they've made. And you can see there's pretty much an increase year on year. Dollar General dipped in 1 year, 1 or 2 years. But the basis is that every year there's this modest increase, 7%, 2.6, 5, 3.5. There's a small incremental growth. So they're pushing north all the time. Their share price is looking strong. And those kind of profits to shareholders mean that they become targets of the big fund managers, the Fidelity, the Vanguards. The big fund managers want to have these. As I said, they're a proxy in terms of food, in terms of drink, in terms of pharmaceuticals, etc. They need to have them in their portfolios. These three companies are all in the top 10 of the largest 36 grocer retailers, food retailers in the United States. So we're talking about three of the 10 biggest ones. Kroger, in fact, is in conversation at the moment to buy out a company, Mathewson's, and that's going to put them into about the sixth largest if that happens, subject to regulatory approval. You look at Kroger, they're a lot smaller, market cap 44 billion, and yet they produced 147 billion in revenue. I mean, these are stunning numbers. Okay, you look at the profits, which is the last dot in each of those companies, the last bullet point, 33 billion, 31 billion, 30 billion, 29 billion. You can see there's a rising, the boats are rising. Dollar General, the smallest, as I said, it's more in a sort of retail space in terms of the rural area. That's half the size of Kroger, 21 billion. Again, it's not shabby. It actually produced more revenue. Produced double its revenue in terms of its market cap. So these are companies that I've pretty much put a theme at the bottom. 3 structural features make these companies a worthwhile look-see, and those are: we're always going to be demanding food. It means there's consistency of demand, cash flow strength, because these businesses don't carry a lot of debt. They're very cash flow. It's called free cash flow in terms of what they can do with their money. To rebrand a store, to roll out a new store, it's not cheap. It's not like a nuclear power station in terms of like one of our energy notes we did recently. To produce a nuclear power station takes years and years and years to get it approved, and it takes years and years to build. This is different, but they've got the advantage, the competitive advantage of being in the right place, established as a family name, as a trusted name in consumers. So people defer often, say, look, this might be cheaper. It's coming from another country. It's half the price, but I don't know what it tastes like. I'm going to rather go back and defer to something out of Dollar General or something that's on the shelves at Kroger or, available through Walmart. So the work that goes into these companies, it's more detailed in my rationale. And what I don't include in the rationale is a lot of the financial metrics, which are quite technical. But if anybody ever wants to jump under the hood and understand all the technical stuff, I'm happy to share my analysis with them. There are a lot of companies in this world, in this firmament. There are a lot of companies. There were probably 3 or 4 other companies I'd love to have included. And maybe they might form the basis on another note, which would have been equally as strong. But these are the ones that we synthesized down with some work from some other investment banks that I deal with. And we're very, very comfortable, and we're delighted that this particular mix gave us that 15.4. That is important. We need to have something that drives the coupon, and we're delighted with the strength of these companies. Okay, so what's the investment thesis of choosing these guys? Okay, as I mentioned, a lot more was said in the rationale. I keep deferring to that, but I've made 4 major points. Let's go to point 4, and you're already in point 1, I know. But point 4 is trading down. That trading down, let's deal with it. I think we have dealt with it in terms of the migration towards lower tier products, private label products, store branded stuff, lower prices, bigger bulk. When your wallet's under pressure and you've got a family to feed, you're going to see what's good value, and it doesn't necessarily have to have a premium brand or luxury brand producer on it. I had an example this morning where a friend of mine decided to make artichokes in a stew. And the only way to eat an artichoke once you'd done it her way was to have it with a certain brand mayonnaise, Hellmann's mayonnaise, which is an expensive brand, I think. Well, certainly it's exported out of the US. I think it's not that expensive in the US, but it's still a premium brand. And she said, I don't care how much it costs because that's what I want. And I'll make do. I'll cut corners somewhere else. So again, to my point, there's a diversification in sentiment where people will say, I still want to have something that really ticks my box, but I will have to do with something that's going to look after the essentials. I might have store branded toilet paper or toothpaste or something like that, but I want my mayonnaise. Okay. Humans are avaricious creatures. They need to be satisfied. And interestingly enough, I came across a statement by Sam Walton, okay, who started Waltons. The Walton family started Walmart, I beg your pardon. It is probably the wealthiest family in the world. If one maybe excludes some of the principalities of the Saudis, but it certainly is one of the wealthiest families in the world, shared between about, I think, 4 direct siblings at the moment. But Sam and Bud, who started Walmart, analyzed the 1929 crash and the Great Depression. And they said what was interesting when they looked at, obviously they were in the food and drink game, wanted to get into that was their space. They said what people would still, even when times were tough, they would have enough money for maybe a bottle of beer or a glass of wine and a cigarette if that was their thing. So there's always a time where people will make allowances, but they've still got to put bread on the table, etc. And consumer staples are generally, when one looks at basic consumer staples, they are products that actually can't be reproduced, that you need to actually have them. So you might talk of bread, you might talk of pharmaceutical medication, you might talk of something like salt. It can't be really it can be, I suppose it can be reproduced chemically, but these are things that are difficult to reproduce cheaply. Okay, so they benefit what I call is from structurally inelastic demand. It means it's always there. It's not like a rubber band where it builds up tension and shoots off, and then suddenly there's no interest in the rubber band because it's not flying. It's always there. The tension is always there. The food, the basic tenets of survival, of living. Maslow's hierarchy of needs is a roof over your head and then food and water. It has to be there. And those particular, I mentioned them, food, beverages, hygiene, cleaning products, are things that we pretty much need. We might cut down in consumption. The margins are thin on these companies, but you can see their profitability just keeps pumping through, even with those very high interest rates. And these companies possess and have presented over the last many, many years strong brand portfolios. They keep going, they keep innovating. The innovation post-COVID was, clicks, not bricks. So many of them have moved away from store-based selling to e-commerce-based selling, which might be cheaper in one respect, but then you've got a fleet of guys delivering, whether it's Amazon or somebody else. And many of these companies have tie-ups with delivery companies. I mean, Amazon is quite closely integrated in terms of delivery services with something like Walmart. And there's that trading down phenomenon, which is a very real phenomenon. And that's something that probably has been going on now for, I would say, the best part of 2 years in the United States. But these companies are very well positioned geographically across the states to, literally have that integration, both horizontally and vertically, into the different demographics of who can afford what. There's always going to be, and I mentioned to the Australian group this morning, there's always going to be that sector of the economy that are above, they've got more than enough discretionary money to say, well, I can afford whatever luxury good if it's imported from France or Italy or the UK, or it's a Scotch, or it's a this or it's a that. That's fine. And that's on the staple side. This is not really non-discretionary spending. Then you might have discretionary spending, which is something like, well, I need to get a new pair of golf clubs, or I want to buy a new jet ski, or I want to buy a new yacht, or I want to buy new running shoes or tennis racket. It's not that it's absolutely necessary for your survival. You might think it, but you can make do until things ease out and maybe the interest rates come down. But food is something you need to keep eating. Cleaning equipment, medication, and so forth. Okay. So the strategic positioning of these companies. Let's have a look at the next slide, if you may. So we haven't. I was challenged a bit by a comment where they said, what about this company? What about that company? What about the next company? And I mentioned there are a lot of different companies and a lot of this sector which offer a lot of this value where people will trade down, where they need to have access to these type of services and products that these companies produce. I mean, as I mentioned, I probably had a firmament. I had a starting sort of basis of maybe 20 companies, and basically I synthesized it down to these three. But it's not just the broad sector. We could have maybe done an ETF, electronically traded fund, US consumer staples and discretionary and non-discretionary. We could have mashed it all together, and Graham could have said, well, it's come out with a 10% coupon. Obviously, when you are coalescing your focus into maybe 3 shares, your risk factor does go up because it's on those 3 shares, those 3 companies. So the work we have to put into here has to be deep and it has to be detailed. Whereas an ETF is a lot broader. Some parts might work, some parts might not, and overall it sort of bumbles along. Always remember, we don't need these companies to shoot the lights out. We've chosen companies that have very modest gains in terms of their trajectory, because they have very low margins in terms of their profitability. But they're money machines, and they just trundle along. They're like super tankers. They're not like nifty little ski boats. But they've got very broad portfolios. They cover everything. Literally from turbines to toilet paper, if I can call it that. They've got something for everybody. And And we generally, as I mentioned, we had a big firmament of companies, but my focus was more towards the basic requirements of, as I mentioned, the essentials of food, beverage, and those type of sectors, and cleaning, etc. So they're not as sensitive as maybe a sector where people will change very, very quickly their mind. There'll always be a requirement for, I'm being maybe fairly blunt here, there's always a requirement for toilet paper. There's always a requirement for hand soap, for toothpaste, toothbrushes. That's simple stuff we don't think about as an investment, underlying investment theme. But we need these, and we don't need it to come out of, it doesn't have to be a French toothpaste. It can be made in America, which will really appease the government, and not made in China. People will trade down. They'll say, like, look, while the times are tough, I need to preserve my dollar, make it stretch, go further. I'm going to stay with the guys I know. I'm not going to try anything new. I don't want to risk that. And value companies. I always look for value in a company. I mentioned Dollar General, lots of value there at the moment. If I look at the Wall Street analysts at the moment, they've got it as a buy to a strong buy. So there's no indication that you should go and buy the stock. I'm just saying this is the sentiment that is out on the market. Can change in a heartbeat, obviously, if something goes wrong. But they've got good track records. They've got good management teams. Now, this is the stuff we look at. How are they appreciating, and how are they integrating and becoming invested with their communities? As I mentioned, Dollar General is not in the big cities. Its target is the rural areas. So, and you see this, globally. You often have this diversification between companies. Okay, so in a nutshell, how do I roll this up? Because I've been speaking for a while now. So in a nutshell, I sort of broke it down to this. It's a strategic pillar in any defensive allocation within a portfolio. So whether it's a structured note, or whether it's a diversified portfolio, whether it's a whole group of unit trusts that you've got going, it constitutes a defensive pillar. And it offers this rare combination in the first point. There's revenue stability. You saw that for the various years. There's constant, it's not up and down. One year it's a hit and the next year it's a miss. It's constant. It might be a little boring, but the numbers are certainly staggering in terms of, if you look at what those billions, it's not millions, it's billions that they're producing. Robust cash flow. And cash is king. We've all heard that. Cash sorts out problems, and cash lets you take advantage of opportunity. Very, very important in a business's life. And sustainable dividends. If you start paying back to your investors a little dividend, it's actually quite nice. You've got some cash flow coming back to you. So these are companies that are looked at very closely by the big institutions. That's something else I look at. If a big institution is following a company, they've got teams and teams of analysts, quantitative, qualitative, you name it, wearing very sharp suits and all the rest of it, doing lots of analysis. It's a good feeling for me. And quite because of all those points, those 3 points, they can withstand inflationary pressures. They've shown it over the last 4 years. They've shown what they can do. And yet their growth is modest. It's organic growth. They open a couple of new stores here. When I say new stores, I mean some of them are opening hundreds of stores at a time. America's a very, very big place. And I think the other point is, and the last point, I think this is, to me, probably one of the most important points that I take away from this presentation. Within a structured note, which Jill's going to explain some of the benefits in terms of the protection features, in as much as you could hold these shares in their own right within a portfolio or as a share allocation, we put them into a structured note, which we wrap further protection around in terms of the capital protection, the Autocall, which basically allows us to bring the coupons into play, into your wallet. There's a lot of protection we look at here. So again, it's to that point of all these headwinds we're facing. We've tried to build an economic moat and put your investment behind the moat, like the old castle adage, to create more protection. And I think that's a very different scenario as to saying, well, I'm just going to go and try and pin the tail on the donkey and buy a share because it looks quite nice. This is a more modest approach, like these companies. It's modest, it goes very well, and at 15.4% per annum, I can tell you now, I talk to a lot of fund managers internationally at all the big numbers, the big banks, and these numbers, they make them green with envy. If it's a modest portfolio, if it's a low growth portfolio or a balanced portfolio, 15% per annum in US dollars, if you tick those T's and C's, is a stellar return. It's absolutely stellar. So we're delighted that Graham and the team managed to twist the arms and get us the allocation. I'll end off by saying it's probably the third note I said on this trilogy that we've launched, which have shown absolute enthusiasm amongst our communities, and it showed. So I'm going to hand over to Jill, and yeah, have a look at it and let us know. It's, as I mentioned, we've unfortunately running short of capacity again, so it's one of the problems we have to deal with, but it's a nice problem. Thank you.
Great. Thank you, Andrew. So just remember that if you've got any questions, please pop them into the chat because we will be going through them shortly. So just in terms of the note itself, the issuing bank is BBVA. There are the ratings, Moody's, A3, S&P A, and as you know, we only work with systemically important banks. The coupon, it's a reducing autocall. It's a growth note, so it's not going to pay out any income. It will accumulate the coupons, and I'll show you in a short while how that works. The coupon rate, as Andrew said, 15.4% per annum, which is a snowballing coupon. Again, I will show you shortly, that accumulates at 7.7% semi-annually. The maximum term for this note is 4 years, but it must autocall in order for you to receive the returns. The Autocall also, an added feature, has got a reducing autocall. Sorry about that. Is a reducing autocall, which means that each semi-annual period after 12 months, the autocall trigger drops by 2.5%. So it becomes easier and easier to autocall. The reference basket, Andrew has gone through, and then your capital protection is sitting at a 60% final level. So your capital is protected right up until that last observation. And at that point, as long as the underlyings remain above 60% of their start price, you will receive all of your capital back. And that is only in the event if there is not an autocall. Availability, the note strikes on the Monday. So our closing date for investment, where your funds need to be cleared and your instructions in with your trading platform, is the 17th of October. And again, the minimum investment we're looking at is from $10,000 upwards. So as I said before, the note must autocall. For those that are new, the autocall is a mechanism that triggers an early maturity. So although there is a 4-year term, the autocall trigger will make it mature earlier than the 4-year period, the 4-year term. The structured note will automatically mature and pay out when the underlying basket is at or above the autocall trigger level on any of the set observation dates. As I said, all underlying stocks must be above that trigger. With the reducing autocall, that level drops each quarter, each semi-annual period. So we spoke about a snowballing coupon, and what I'm going to do is just run through quickly. A snowballing coupon is for each observation that passes and the note doesn't autocall. A coupon, that's 7.7%, is rolled up, it's accumulated. When the note autocalls, you're going to receive the accumulated coupons in one payout. So you can see from the graphic on the right, the ball gets bigger and bigger like a snowball rolling down a hill. Autocall feature, again, reducing. The feature goes live from month 12, which is actually the second observation. So if the note autocalls at the first autocall opportunity, you will actually receive 2 coupons. Your autocall trigger starts at 100%, which means that at 12 months, if all of those underlyings are at or above their start price, the note will autocall. If not, it will go to the next observation where it'll drop down by 2.5%, and then every 6 months drop by 2.5% until it does autocall. That makes it easier and easier for it to mature early and pay out the returns. And then finally, we've got the capital protection barrier that's built in, that if there is no autocall, no coupons are going to be paid out, but as long as your underlying stocks remain above 60% of their start price, you will receive all of your capital back. Then just important information and dates. On the fact sheet, you'll always see the list of observations on the left-hand side of the left column, and those are the all the observations that will take place. The next column, we have the observation date, so you know exactly what date we're going to be observing those stocks. Then we have the payment date. In the event of an autocall taking place at an observation date, you now have the date where the funds will actually leave the investment bank with your returns to your trading platform. And there you see on the right-hand side, the autocall trigger that starts at 100% at the first observation, 12 months, and then reducing by 2.5% semi-annually. And then at the very bottom, you've got your final observation where we've got 60% final level, which is your capital protection barrier. Then finishing off, all you need, if you do not have a trading platform, you will need a trading platform, which is a custodial platform that's going to hold the contract on your behalf. If you would like a list of platforms that do hold our notes, just pop an email to support@cashbox.global, or just pop a note into the chat and Logan will pick it up for you. We are platform agnostic. If you already have a trading platform, we can always check and see if they will hold the notes. We will then, once you've expressed your interest and let us know how much you would like to reserve, we will give you the International Securities Identification Number, also known as the ISA number, which is a unique identifier for specific securities. So this note will have its own unique number, which is trackable on Bloomberg. And then in terms of what we do reporting, we keep you informed, we will let you know the note has issued, what the strike prices were, so you always know what we're comparing against. After every observation, we will give you an update on the outcome of the observation, and then naturally, if the note matures, we will let you know that as well. From an ongoing support perspective, Andrew does, if you haven't seen it yet, Andrew does a weekly roundup, which we're getting such good feedback on. People are really enjoying the weekly roundups where Andrew actually looks at what took place during the week, what's coming up in the following week, and how that might impact the world of investments. We also issue ongoing insights, articles, etc. There's a lot of information around structured notes, so we're always happy to do refresher training and then general support. And that is also where Logan comes in. He's a great support to our base. Again, closing date for instruction and cleared funds is the 17th of October. Please drop us a mail so we can reserve capacity for you. As we mentioned, the previous two notes have been quite amazing. Thank you, Andrew. Thank you, Logan. And thank you, everybody, for joining us this evening. Again, any questions, drop us a mail at support@cashbox.global.
Thanks, folks. Have a good evening.
Well done,
Cheers.
guys.
Bye-bye.
Take care.
Thank you.
Cheers now.